Hello, everybody, and thank you for joining us. My name is Scott Aitken. I'm an advisor with Wild Wealth Management Group. I'm based out of our Tempe location. Today, we're lucky enough to have Gene Goldman with us for our fourth quarter market outlook call. A couple housekeeping items really quickly. Our nonprofit, Wild for Arizona, as most of you know, we dedicate our time and resources to a different charity group every quarter. For the fourth quarter, we're proud to announce that we're teaming up for the 17th consecutive year with Toys for Tots. So feel free to drop off unopened, unwrapped toys to any one of our locations. We also have a list of items that we're looking for that can be found on our website on the events page, or you can email us at info@wildwealth.com and we'll be happy to send that over to you. Couple other things, we do have some more educational events coming up for the fourth quarter. For October, the topic is Retirement Savings Challenges for Women. That's a webinar hosted by yours truly. That will be on October 27th. We're going to do that twice at 12 p.m. Arizona time and 6 p.m. Arizona time. And then November, the topic is Planning for Long-Term Care. That's going to be hosted by Seth Wild. That'll be November 24th at, again, noon and 6 p.m., both Arizona time. So if you're not in Arizona, that might be different for you after daylight savings occurs. And then December will be Retirement Income Planning hosted by Jeff Anthony. And that will be on December 29th, also at noon and 6 p.m. One more thing, most of our clients have, a lot of clients have been with our firm for 10, 15, 20 years. And we've always done our annual Zoo Lights event in December. Unfortunately, again, for the second consecutive year due to COVID, we had to cancel that for this year. We do plan on starting that up again the end of 2022. So apologies for that. I hope you understand, but we look forward to seeing you all again at the end of next year. Okay, without further ado, so we have Gene Goldman with us. Some of you who have jumped on before might recognize his face. He actually started doing this with our firm right in the midst of COVID last year, so we can't thank him enough for his time. Gene's been in the investment management space for 26 years. He got his MBA from Northeastern University, and you might recognize him. He's on CNBC, Fox Business quite frequently, and he's also cited in many other news outlets like the Wall Street Journal, Forbes, the New York Times, so on and so forth. So again, Gene, thank you so much for joining us.
Thank you, Scott, and thank you so much for everything. Thank you for everyone for dialing in today. I'm very happy to be here. I know you mentioned that I'm on TV a lot. It's not as glamorous as it sounds. I mean, I live here in California. That means I'm up at like midnight to get on TV for 2 o'clock or 3 o'clock in the morning. That means I'm in bed by 3 or 4 o'clock in the afternoon. It's not that exciting. So, so with that said, again, it's a pleasure to talk to you and your group again. Let me just share my screen, and when it pulls up, it's our market outlook screen. And there it is. Okay, so what I want to do is just talk about the economy, talk about the markets, just making sure this is lined up correctly. Okay, so what I'll do is talk about the economy and the markets, of course. If I go into our next slide, and I think this slide is a great way just to look at where we were to where we are going. And you think about this, if you look at this slide, what a year last year was, 2020 was. We talked about this before, but it's important. We had the longest expansion in the history of our country, longest ever, 128 months end. And then it was followed by the shortest recession on record, 2 months, shortest recession. And this, the importance of this quick, long expansion and a short recession is especially important as we look at today. And there's ramifications in today's economy and ramifications in today's markets, especially around this concept of peak economic growth, around inflation. And you're hearing this everywhere. So keep this in mind. Again, long expansion, short recession is really creating havoc in terms of how we're doing, in terms of the economy. So with that as a backdrop, you've seen these before. These are our 3 themes for 2021. And again, we've talked about these many times, and they haven't changed that much. They really haven't. We talked about number 1, the economy has broadened. You look at where we were versus last year, it clearly has broadened. And there's so much evidence behind this. Number 2 is what we want to look at going forward. As you know, earnings, stocks tend to price in events about 6 to 9 months in advance. And we want to look at what's going on down the road 6 months from now. And number three is just market volatility. There is so much market volatility that we expect. We've been wrong on this, but there's so much market volatility that we do expect. If you look at these three themes, the first one has panned out. The second one we are seeing definitely playing out right now. The third one hasn't played out yet. So what I'll do is I'll talk about all three, but I'll really focus on the last two, the risks that are increasing and just the increasing market volatility. So let's go to the first one. And the first one is the easiest, and this is the great news. The economy has recovered very, very fast. Especially where we were last year, especially when we saw the sharp recession caused by the virus last year, by the government shutdown. And if you go back and say, okay, why is the economy recovering so fast? Why did the recession end so quickly? Three reasons. Number one, obviously vaccinations. More people are being vaccinated. There's herd immunity. People getting sick are not being hospitalized as much. Deaths, thankfully, have come down dramatically. The second reason is just a stimulus in the economy. We talked about this last time, but remember back to in the Great Recession, it took the Fed about 8 months, the Federal Reserve, 8 months to cut rates to near zero. This recession, took about 10 to 15 days to cut rates to near zero. Very quick, very fast Fed, creating a lot of stimulus for the economy. And number three, there's just this pent-up demand. People want to spend money. People want to get out there and spend money, but they're having a hard time trying to find things. Eventually, inventory, low inventory levels, supply chain issues will work their ways out. But again, there's a lot of pent-up demand to buy stuff. So to kind of go through, here's some data kind of showing you where we are today. The vaccinations are extremely important because there is the proverbial light at the end of the tunnel. It's important because, if you think about when the virus hit back in February or March of 2020, we had no idea how long would this go. Would this go 1 year, 2 years, 5 years, 5 weeks? No idea. At least we feel better that with the vaccinations, we have gotten through this and we are seeing a light at the end of the tunnel. And this has led to people being more confident, spending more money, being more confident about where they are. So if you look at this slide, this slide shows GDP, and GDP is the output of our country, what we produce, goods and services. We are back to pre-pandemic levels. Great news, okay? If you take this next slide, and I showed this slide to you before, but this is really one of my favorite, indicators just to show how quickly the economy has come back. Retail sales. So retail sales have surged. And if you think about the Great Recession, and that's from 2008 to early 2009, it took us about 40 months. It took us over 3 years to get back to pre-recession levels of retail sales. This expansion, this recession we had last year, it took us 5 months. 5 months to get back to pre-recession levels. You and I, consumers, we're spending lots of money, and this is helping the recovery broaden faster. So again, the recovery is around vaccinations, it's around stimulus, it's around this pent-up demand. So that's the great news. That's where we are today. Now, if you kind of look forward and say, okay, that's great news, things are going well. Yes, there's some slower data, and we'll talk about this in a second, but what are the three risks that we see on a go-forward basis? And I hate to say this, but the three risks that we've talked to you about many times throughout the year are panning out. They are playing out. We've been pounding the table all year with you and other clients of Wild Wealth Management that, these three risks are really important, and the markets need to focus on them. So these three risks are, number one, peak economic growth. Basically, if you look at this next slide, peak growth. What this means is that, are we at the highest point of our economic growth cycle right now? And if you think about an economic cycle, in a normal cycle, you see the early cycle where things come out like gangbuster, and then it starts to slow down. We are starting to see this right now. We're starting to see peak economic growth. If you look at some of the data, the IMF came out with data just this week talking about economic growth should slow down next year versus this year. They also ratcheted down their estimates for this year and next year also. So growth is starting to slow down. There's also peak economic stimulus. There's talk about tapering, and I'll talk about what that means later, but the Fed is undergoing a tapering process. And there's also peak earnings in the sense that, is this as good as it gets for earnings? And I'll talk about this a little bit later too. But if you look at this recovery, and you go look at this slide shows consumers, you and I, we are spending money, but our confidence is a lot less than it was before. You can see the confidence has dropped down dramatically. And why do we care about confidence? Well, again, consumers spending is about 70% of our economy. So if we're becoming less confident about rising inflation, if we're becoming less confident about, getting the things we want to buy, if we're worried about what's going on from a rent standpoint, from a housing market standpoint, all these issues, it's really, really reducing consumer confidence. And again, there's ramifications because Again, this affects consumer spending. If you look at this next slide, and you're probably thinking of me saying, Gene, you just talked about how retail sales were great and they're phenomenal, and why would the consumer be upset? Not upset, but lacking confidence. Well, you look at this slide, and this slide is from our friends over at at Bespoke. And what I like about this slide is that it breaks down the segments of retail categories. And if you look, there's four columns. The left-hand side is the categories, and then month over month, year to date, and year over year. What you see in the middle column, that year to date, over the last year to date, since the beginning of the year, spending at bars and restaurants is up about 41%. That's a dark green data point. That's great news. People are getting out and going out. We're spending. We're going to bars, going to restaurants, doing whatever we do. Just having fun at restaurants and bars because we're getting out. That's great news. But if you look at the last month, and this is through the end of August, September retail sales hasn't come out yet, but through the end of August, it ranks the sales in terms of high versus low. The number one retail sales was online, non-store online sales. Furniture is another issue, and then you see general merchandise, food, and beverages. What this suggests to you is that consumer confidence has gotten a little concerning in terms of the virus, a little bit about the Delta variant flaring up a few places here and there. All we're trying to say is that, yes, retail sales have been very good, but now you're starting to see the underlying data starting to churn a little differently. This is sort of a little bit of a concern in terms of what people are spending money on. No longer is that confident going out to bars or going to restaurants. It's instead spending on non-store online businesses. If you look at loan growth, and this slide, so this is a busy slide, and I apologize, I hate busy slides, but it's plotting 2 points. The light blue line is cash at bank balance sheets, and banks have a ton of cash because whether it's the money from the stimulus checks, people are saving money, whatever it is, there's a lot of cash at bank balance sheets. The dark purple line at the bottom is more important. This is loans. These are banks making loans out. And loan growth has started to slow down quite dramatically. We saw this week that a lot of the major banks have released earnings, and the numbers have come out really good. Part of it is really driven by loan loss reserves being released. That's basically saying that banks are becoming more confident about the environment, and they're starting to say, we don't expect to lose as much money in terms of loans. So there's confidence there. But what we're not seeing is a pickup in loans, and it's a little surprising. If we are in a strong economic environment, you would think that companies and people and everyone will be taking out more loans. We're just not seeing that. That's something that we're watching and worries us in terms of this whole peak economic growth. If you look at this slide, and this slide, I thought the last one was busy. This is even busier. This slide plots what are called regional manufacturing surveys. And these surveys are very small, focused surveys. And I know we've talked about this, especially we talked about it during the beginning of the recession last year. But these surveys, they're very small. They focus on areas like Chicago or New York or Philadelphia, just small regions. The beauty about these surveys is that they're the first look at the current month's economy. And you see on the right-hand side, and taking a step back, you look at data. There's tons of data. We get tons of economic data, GDP, retail sales, but it tends to occur after the month has ended or after the government has a chance to create and edit the data, or not edit, sorry, that's a bad word, have a chance to review and analyze the data. The regional surveys, why they're so important is because it's the first look at how the current month is doing. And you see on the far right-hand side, things are starting to roll over a little bit. Yes, they're very small surveys, but these are the first surveys that were hit when COVID first hit our country. So again, something we're watching, again, just more evidence of things slowing down. If you look at this slide, and I know I've shared this with you before, but this is a key slide. If you think about the world of the economy and you think about stocks and earnings and so on, the stock market loves a positive economic surprise. That means the data is coming better than expected. That means the data is exceeding what investors had expected. It's good news. That means the economy is better than anticipated. It's good news for the stock market. So with this slide plot, it's a city economic surprise index. Every time a data point exceeds expectations, the line moves higher. If it misses expectations, the line moves lower. What do you see on the far right-hand side? The data has come down dramatically. The data is not beating. It's not meeting exceeding those expectations. Again, this goes into that theory, our expectation that we have gone from an early cycle recovery to a mid-cycle recovery. Things are going to start to get a little more difficult. We have difficult year-over-year comparisons. We have slower economic growth. We're still growing, and there's no recession that we see in any time. But this is sort of that point where people are saying, hey, the economy is starting to slow down a little bit, just slightly. And we'll talk about this later, especially when you add the concept of inflation to this. So inflation, that's our second concern. So the first concern is the slowing economy. And why is that concerning? Because if the economy is peaking, everything else is likely to peak too, like stimulus is peaking and earnings are peaking. Again, there are ramifications in the stock market. The second concern that we have is inflation. Inflation. Prices are moving higher, and you see this already. Prices are rising, and you're seeing it every single day, whether it's staples like meat, whether it's like energy, like oil is up, 40%, 50% year to date. Oil is up dramatically, and we'll talk about that in a second. But you look at this slide. This is what's called the ISM Manufacturing and Services PMI. It's a mouthful, but all this is a survey of purchasing managers, people on the front lines who buy stuff, who purchase stuff, purchasing managers. And there's a bunch of different indicators. Above 50 is good, below 50 is bad. So above 50 is expansionary, below 50 is contractionary. If you look at these slides, prices paid. This is what companies are paying for things. Prices out there, getting prices, buying things. We're at around 80. That's a high level. That's a super high level. It's very, very concerning. Things are getting much more expensive. So if companies are paying more, why does that matter? It matters because this hurts company profit margins. So now if you're a company XYZ and you're going out and buying stuff, and it gets more expensive, all of a sudden your cost of doing business start to increase, and you're having a difficult time passing these prices on to consumers. Yes, we're seeing prices go higher, but companies are not raising prices to the same degree. A little simple metric you can look at, and there are some differences in terms of the components, but something to think about: PPI versus CPI. PPI is Producer Price Index, and this is what businesses are paying, basically, what they're paying for in terms of costs. And then CPI is what consumers are paying for. Theoretically, if a business can pass on costs to the consumer, CPI goes higher. But if you look, we just got some news that PPI over the last 12 months is up 8.6%. Up 8.6%. So business costs are up 8.6% on average over the last 12 months. CPI, Consumer Price Index, is up about 6% year over year. So what this suggests is that companies are having a hard time passing these costs on. So there could be some issues around profit margins. And as you know, profit margins drive earnings, and earnings drive stock prices. And speaking of earnings season, we're the first week. We started earnings season. The official start of earnings season was this week. And I read something yesterday that the phrase "supply chain issues" has been said 3,000 times already in earnings reports. So again, this is the first week of earnings season for the third quarter. Supply chain issues, that phrase, has been mentioned 3,000 times in the first couple of days. Again, companies are having supply chain issues. The biggest component of inflation right now, in addition to trying to find goods and services, is labor, is wages. And you look at this chart, we are in a great environment in terms of if you're looking for a job. So this chart, you can look at the unemployment report, you can look at jobless claims. Jobless claims came in below 300,000 last week, first time since this pandemic started. That's great news. There are so many jobs out there. There are tons and tons of jobs. But if you look at this slide, we plot data very differently. The number of people unemployed relative to the number of jobs. And right now it's 0.8. That means there are more jobs, 25% more jobs available than people looking for jobs. Great news for you and I. If we want to get new jobs, there are so many jobs out there. The problem is, though, if you're a business today, and you're trying to hire someone, you need to start to boost wages. You need to start to increase bonuses. Another thing, I saw this. There's a restaurant near me. We talk about this in my team meeting. There's a burrito shop. Okay, it's a burrito. Good burritos. Nothing's fancy. They have signs out front saying, we're hiring at $18 an hour, plus we're going to pay 401k, plus we are doing health insurance. Again, it's a burrito shop, and think about that. Think about the margins. But at the same time, one thing we've been watching, this burrito shop is able to raise prices from $7.50 to $9.99. So again, you're seeing inflation creep up everywhere. If you look at this next slide, okay, going back to sticking with wages, okay? So this slide is interesting. It's a busy slide. This is from our friends at Yardini. What they've done, and I love what they've done here, they plot out wages by low income, higher income wage workers, and then all workers. And the important point is that red line. lower wage workers, non-supervisory and production workers, 81% of the workforce, 81%. Wages in the last 12 months, and this doesn't show it here, but in the last 12 months, they're up, last 24 months, it's up 9.3%. Wages are jumping dramatically. It's an inflation pressure, a huge, huge inflation pressure. You look at this slide. We are in a global energy crisis. You're not getting a lot of press on this lately, but energy prices are rising dramatically. WTI, West Texas Intermediate crude, it closed above $80 for the first time, I think, in 7 years? No, I forget what it was, but West Texas Intermediate crude, it closed above $80 for the longest. It hasn't been that for the longest time. And what's going on with energy? Why is energy moving so much higher? And there's so many reasons we can look at. The easiest thing is, first of all, look at U.S. production of oil. We are about 2 million barrels below where we were pre-pandemic. So remember that whole story where energy went negative back in March? We talked about this before, March of last year, because Cushing, which stores a lot of the oil, was basically full. And basically oil drillers could not store oil in Cushing, Oklahoma. So what they had to do is they basically just started giving oil away for free because they can't close their wells because there's environmental issues and so on and so forth. So basically, oil prices cratered dramatically. Now oil is about $81 a barrel. And again, U.S. oil production is about 2 million barrels less than it was pre-pandemic because a lot of these oil wells started to shut down, and it's hard for them to reopen. Also, if you think about environment, oil companies are really apprehensive of going out and doing a lot of capital spending to rebuild these drills and these wells because there's all this talk about green energy, about wind power, and so on. So now, if you're a major oil company, a major oil driller, do you really want to increase your capital spending on something that may be impacted by alternative energy? The other issue is that they're also having a hard time finding workers. Again, oil field workers. I have a friend of mine. He's working on an oil field, an oil drill, one of those drills off the coast of Texas, and they said they basically have a hard time trying to find workers, key experienced workers. So you take that on the U.S. side, and then if you look at OPEC Plus, basically the cartel, in other words, not the Colombian cartel, but the other cartel, the oil cartel. And what they are doing is that the government, we expected them to raise production. They raised production very little bit. So this is putting also pressure in terms of supplies. And then of course you add demand. People are using more oil. People are driving much more. Also, if you look at other energy, it's not just oil. Look at China, for example. China, I'll talk about this a little bit later when we talk about China, but China is fighting with Australia and they're not buying Australian coal. So because of that, the price of coal has jumped dramatically. And we'll talk about that in a second. So, and then of course in Europe, the Russians are kind of using their natural gas pipeline to kind of hold the rest of Europe hostage because they want some other regulations passed. And this is really putting a damper on, it's really pushing natural gas prices higher. So we are in a global energy crisis right now. And again, I'm not sure if we see anything really opening us up anytime soon. So with all that said, what's our take on inflation? And this is something we've been telling you, every time I've spoken to you. We feel that while the Fed says inflation is transitory, we don't believe it. There's so much evidence that they're wrong. Wages, food prices, oil prices, there's so much inflation pressure out there. And there's so much evidence that the Fed will be wrong. And we've been saying this for a long time. And if you look at what that means, so the Fed is worried about inflation. They're starting to worry about it. You see some of the Fed talk, they're talking about tapering. I'll talk about tapering in a second. But really, inflation is basically a tax on the consumer. So if you think about that consumer confidence stuff I talked about earlier, how it dropped dramatically, the biggest comment that came out was inflation concerns. If you look at, I can't talk about individual companies, there's rules and regulations, yada, yada, but there's a big retailer out there that came out, this is maybe a couple weeks ago, and they were expected to earn 52 cents a share. And this is a retailer that we all go to when kids go to college and you go and you buy stuff to for your dorm rooms and so on. And this retailer expected to earn 52 cents a share. This retailer earned 4 cents a share. That's a huge miss. And if you read the note, why they missed it, they missed because supply chain issues, which we talked about before, and the other impact, which I don't think is getting much press, which is important, is that they said that people's worries about inflation is starting to reduce spending at their stores. It's concerning. So again, we're watching the impact of inflation in terms of company earnings and so on. So what's the Fed doing? The Fed announced they plan to do what's called tapering. And not to go into the weeds, but basically what it is, it's a reversal of their stimulus. So what the Fed did, remember we talked about this March of last year, the bond market kind of seized up, and basically companies wanted to go out and they wanted to borrow money. Big companies like, big retailers just wanted to go and borrow money because they needed to, finance their operations. And the bond market seized up, and when it seized up, borrowing costs surged dramatically. So what the Fed did is they did what's called quantitative easing, where they go in and buy treasuries and they buy mortgage-backed securities. And what you do that, you buy these securities, you pull them off these banks' balance sheets, and you replace it with cash. Supply and demand says if you have more cash in your balance sheet, you start to lower your interest rates and you start to lend it out. That's a way to stimulate the economy. The Fed also cuts rates too, but that's a really big way to stimulate the economy. This has proved to be so well. The economy seems to be okay and standing on its own feet right now. So the process you're hearing more and more is called tapering. And tapering is the reduction of those purchases of mortgages and treasury securities. So we did get some meeting notes from the Fed. This came out earlier this week. And basically, the storyline is likely that the Fed will start to undergo tapering, start to reduce those purchases beginning in November. And the plan is that they'll reduce it by $15 billion. Again, this is not set in stone, but this is what we most likely see at the next Fed meeting in November. They announce this and they start to taper in November, $15 billion. And you think right now that if you think about $15 billion, this lasts about 8 months, and then tapering should be done sometime mid next year. Then the question comes in, okay, tapering is a way to reduce stimulus. What's next? Well, theoretically, what's next is to raise interest rates. So the notes that we saw at the Fed meeting from the September meeting that came out this week suggested that the Fed may have to raise rates twice next year. Again, nothing is set in stone, but the market up until a month ago had priced in the Fed raising rates maybe once next year. Now the markets are pricing the Fed's raising rates twice next year. Why is that important? If you raise rates, the Fed raises the rates, credit card loan rates go higher, interest rates go higher, home equity loans go higher, mortgage rates theoretically go higher. So it slows the economy down. This is what the market's a little bit worried about. Myself, from a perspective, we think that one makes sense. We don't think two makes sense. Yes, there's inflationary pressures, but again, inflation will start to slow down a little bit, not go where it was before, but should start to slow down. Also, we saw a couple Fed governors who, let's just say they made some interesting trades in their own personal portfolios. They are retiring. So most likely they will be replaced by more dovish Fed people. So dovish means less likely to raise rates. So you take those two into consideration, and a couple other Fed governors, their terms are expiring early next year. That's 4 people. And if you think about the Fed today, half of the Fed is very, dovish. That means they want to keep rates low. The other half want to raise rates because they're worried about inflation, half and half. So now if half of those, 4 of those are gone, the Fed all of a sudden takes a little bit more of a dovish bias. Again, this is something we're speculating, but we're watching this very carefully. I know I kind of rambled and I do apologize, but the issue here is that we do believe tapering, the slowdown of the stimulus, will go on until mid next year. The Fed will stop and look and see what's happening and most likely raise rates once, although the market is starting to say they'll raise rates twice for next year. So that was a mouthful. Okay. So again, the issue, number 1, peak growth, peak everything. Number 2, inflation rising much faster than the Fed anticipated. Number 3 is something that we've been saying to you all year. And now the market is finally saying, oh my God, that's actually an issue, is that China is slowing down dramatically. So if you look at this chart, this is a Caixin PMI index. Above 50 is good, below 50 is bad. I know you're looking at this chart saying, Gene, it's above 50, it's good. Yes, it's true, it's good, but you can see it's wavering around that 50, 52, 53, 55 level. Again, things are slowing down in China. You can look at retail sales. You can look at industrial production in China. You can look at business investment. All of these have disappointed dramatically. Also in China, there's been a huge surge in commodity prices. Think about this, okay? CPI, Consumer Price Index for fuel. Think about that. Fuel, what the Chinese consumer uses to buy gas or driving, what do they use? Okay, CPI in the last 12 months is up 26% for fuel. 26%. Gas prices are rising dramatically in China. Why is that happening? What's going on in China? So there's a few things. First of all, China, as I mentioned, is fighting with Australia. Australia, again, we can talk about this for hours, but Australia wants an investigation in terms of where COVID started, and China didn't like that. So China stopped buying Australian coal. So because of that, there's a shortage of coal in China. Coal prices have surged dramatically. The other issue is that the Winter Olympics are in February of next year. And what China has wants to do is that they want to reduce the amount of bad air in China. They want it to look beautiful. So what they're saying to their businesses is, hey, we're going to do some rolling blackouts for electricity. And we're also going to have you rolling blackouts so you won't pump as much pollution in the air, so it looks better for the Olympics. And we also can't fulfill all the energy needs. And that was the whole thing about Bitcoin, how they said no more Bitcoin, mining in Bitcoin. So all this is really playing into the Chinese economy. It's slowing things down pretty quickly. I read about this one company, this one bag manufacturer in China. They were running 6 days a week, 12 hours a day shifts. Great, they were just producing stuff, producing like crazy. Now they're down to 1 to 2 days a week because of rolling blackouts. So you think about the ramifications in the world's second largest economy. All of a sudden, they're not producing as much. They're slowing things down. The other issue about China, and this is what's getting a lot of press too, is the regulatory issues. So if you think about, and actually, let me take a step back before regulatory. The other issue is about Chinese properties. There's that big company, again, I can't say company's name, but they basically missed some interest payments. And it's bad. It's bad news because property developers are about 30% of Chinese GDP. Also, 90% of Chinese people in China own houses or own property. And then about 70% of Chinese wealth is tied to properties. So now all of a sudden you've got now these three property developers have said, we're going to miss interest payments. We're not going to make our payments. It's pretty bad. Imagine a big company out here, a big ginormous company out here says we're not going to make our interest payment. So again, this is affecting the Chinese economy. So let's go to the regulatory issues in China. So China is facing these two issues that's going to impact their economic growth. So number one is they're trying to reduce income inequality. Why is that the case? Well, you think about China, and I know we talked about this, I think we talked about this, but China had a failed policy, the one-child policy, and it was basically to slow down population growth. So they did the one-child policy from, I think, 79 to 2014. Then you also add that is China is facing a dramatic urbanization. People are moving out of farms into the city. The combination of one-child policy and urbanization, this reduces the number of children being born. And then if you look at the aging population in China, China is aging so very, very fast. And China really doesn't have the social infrastructure to take care of older people, unfortunately. So you have a very aging population. And there's a joke out there that says, China is going to be the world's largest nursing home. It's probably true. China is aging so much fast. So what did China do, the Chinese government? They're incenting their people to have more children, and they realize this is issues. Just so they're incenting their people to have more children. The problem is behind this is that it's very expensive to raise a child in China now, and China is realizing this. This is why, it's very, very expensive to go out and raise another child. So this is why China is targeting those industries like private tutoring, like technology companies, in order to reduce some of those costs and really redistribute some of the wealth. Again, it's a communist nation. I mean, there's no surprises there. They're looking to redistribute that wealth. The other issue that China is seeing that's, again, it's going to impact growth on a go-forward basis is how they bring out new ideas. So Chinese government said to companies, businesses and service companies, they said, listen, we want new stuff. We want our economy to grow. We want our consumers to buy stuff. Just buy stuff. We want to be like the United States. We want to have a big consumer presence buying stuff. What China did, though, it's very different than what we do. China said, okay, you Chinese companies, build stuff, make stuff, bring it out, and then we'll create the regulations later. In the United States, we create the regulations. Here's the regulations you have to operate in, and then you can build something based on that. China is now realizing that that the regulations are pushing back into their companies are starting to hurt their companies. So again, this is why you're seeing private tutoring companies, technology companies, they're facing all these issues. So again, take all this stuff together. I know I spent a little more time on China than I wanted to. The Chinese economy is starting to slow down dramatically. This is why you're seeing Chinese stimulus they're starting to reverse some of their stimulus that they had started to take out of their economy. we're watching this very carefully because China is such an important part of the global economy. So again, number one, peak growth, peak everything. Number two, inflation. Number three, China slowing down are likely to cause some issues on a go-forward basis. The last theme that we talked about that, we talked about you many times, and the thing that we've been wrong on, and I apologize, we're wrong on this, is that market volatility would increase. You would think as the economy slows from an early cycle to a mid-cycle recovery, that things start to get uncertain and people get concerned. Hasn't happened. Markets have embraced good news and bad news like crazy. If you look at this slide, this is where we've been wrong. So what we've done is we plotted the average daily trading range of the S&P 500, how much it moves each day. And you see on the far right-hand side, it's gotten less volatile and less volatile and less volatile. Again, volatility is not seen. Yes, we've seen some big swings in the market. Like some days the Dow is up 500 points, some days it's down 500. But overall, market volatility has not been there. It's just surprising to us. If you look at this slide, remember, earnings drive stock prices. And that's the old adage. That's what we learned in Investments 101. If a company makes more earnings, theoretically, as earnings grow higher and higher, people buy the stocks of the company. You look at this slide. This slide shows earnings growth, and by quarter by quarter. Last quarter, second quarter, we saw earnings growth up 92%. That means earnings grew year over year 92%. But now if you see quarter by quarter on a go-forward basis, earnings are going to start to slow down on a year-over-year basis. We do think the stock market will start to react to this eventually. If you look at this next slide, okay, despite these concerns about inflation, these concerns about peak growth, about China, people are buying in the stock market. Valuations are very high. You see here, and I know I've shown this to you before, we are at tech bubble levels, very high valuation. And we can justify it with low rates and low inflation right now. But this high valuation prices in absolute perfection. Everything needs to work well perfectly, or the markets will see a big volatile swing. So we're watching that carefully. Again, this is a driver for volatility. What we've also seen is this buy the dip mentality. This is why stocks, despite bad news, really haven't sold off dramatically. What this slide plots, it plots the S&P 500 stock market index, and the blue line is sort of that the 50-day moving average. And for some reason, it used to be the 200-day moving average, but now it's the 50-day moving average. Whenever the S&P 500 falls to its 50-day moving average, retail buyers have been jumping in and buying like crazy for some reason. Okay, and if you look at this, only if you look at, you can see where every time it's gone below that light blue line on the slide, you can see only once has the stock market actually sold off below that. Again, there's a buy the dip mentality where investors are buying at that 50, when the stock market goes below its 50-day moving average. Interesting point right now is that the S&P 500, as we are talking now, it is below its 50-day moving average, and the 50-day moving average, which was a support level, as you see on this slide, has become a little bit more of a resistance level. So the stock market is in an interesting time right now, where it's saying, okay, do we purge higher or purge lower based on technicals? Again, I don't want to spend too much time on technicals, but it's an important point where we are right now. Market breadth, and basically this means are more stocks moving higher. It's a greater percentage of stocks moving higher with the stock market, and market breadth has not been that great. For a healthy stock market, you want to see a lot more stocks moving up if the overall index is moving higher. What you're seeing here on the right-hand side, market breadth has started to slow down. It's in the 30s, 40s, 50%. It was in the 90s. So again, a lot of these stocks are moving higher, but not to the same degree that were moving higher before. Stock market has high valuations. So doesn't the bond market. You look at this, the bond market. So this is plotting the spread of high yield relative to treasuries. So what this means is that if you go buy a high yield bond, like a lower rated bond, okay, you as an investor, you want more compensation because you're taking on more risks relative to buying a U.S. government bond. And that's called the spread between high yield and government. This is the high yield spread. As you see, this is at historic lows. That means high yield bonds are very, very highly valued. Could they go lower? Could the spread go lower? Yes, of course. But spreads could widen pretty dramatically. I know I'm getting into the bonds, mumbo jumbo here, but basically what this says is that bond yields are extremely expensive, bond valuations. And then here's a slide. Okay, this is where we're going to go. We're going to stick with more bond mumbo jumbo. Interest rate sensitivity. There's a thing called duration, and duration is basically how sensitive is the bond market to rise. How sensitive is a bond to rising interest rates? We're not going to do a bond class 101 here, but if interest rates move higher or yields move higher, what happens is that bond prices go down. Yields rise, bond prices go down. And the more sensitive a bond is to rising yields, the more sensitive the price will fall when the yields rise. It's called duration. So right now, the duration on the aggregate bond index, which is a benchmark for the entire bond market, is at 6.7 years. That's at historic record highs. We've never seen duration this high before. We've never seen so much interest rate sensitivity. So what I'm saying is that from a stock market standpoint, the stock market and the bond market are very, very, very highly valued. Are they overvalued? Not necessarily, but they're very, very highly valued. These are things you need to watch carefully because remember, the expansion that ended last year is the longest in our history, but we also had the longest bull market last year longest bull market in the history of our country and too. So we are in a very different environment right now. So as I talk about the therefore, what to do, just a reminder, our three themes. The economy has broadened, great news. We are seeing mounting risks around peak everything, around inflation, around China slowing down, and market volatility, which we've been wrong, I apologize. Market volatility should increase. We haven't seen it, but we do think the makings are there for increasing market volatility. So the question to you is, what do I do with this information? What's my takeaway? The key takeaway is think about where we are going on a go-forward basis. The last recovery, the longest in the history of our nation, the last bull market, the longest in the history of our nation, these were long, stretched out bull markets, long and stretched out economic recoveries. When they're long and stretched out and growth is very low, what do people do? They buy growth stocks. They love growth stocks because that's what you do. When you want growth, you go for growth stocks. This expansion that we're in now is very, very different. It's characterized by more growth and higher inflation. And we talked about this many times, higher growth and higher inflation. So because of this, you want to look at other investments, not just growth. Other areas that tend to do well in a higher inflation and a higher growth environment. What does that mean to you? Two things. Number one, first of all, most importantly, stay in touch with your advisor. It's very, very important. Have calls with Scott and all the other advisors. It's very, very important because your situation changes, and changing situations could change your investment objective, could change how you should be invested. And the second thing is diversification. We were in a period where only growth, really just large growth, did well. Large growth was like this, and everything else was like kind of down here. We are in a different environment where different parts of the market are likely going to do better, like maybe value, maybe cyclicals, maybe international, and I say maybe. To get those answers, sit down with your advisor and go over, make sure you're diversified, make sure you have exposure to different parts of the market. We were in a time where only one part of the market did really well. Things are really broadening out because we are in a different type of recovery. So that's really all I have today, Scott. And again, be diversified for you as a client, and always stay in contact with your advisor.
Hey, Gene, I want to take some time to just say thank you very much. We know you're a busy man, and it means a lot to us as the advisors and the employees here, and also to our clients that you take the time out to do this with us. So thank you so much. And on that note too, I just want to say thank you to everyone on the call today. I've been here 2.5 years. The firm has grown tremendously, not only in terms of the clients we're bringing on through referrals, but also through advisors joining our group for many different reasons. It's been fun to watch, and we couldn't have done it without you. So thank you so much for your trust and your loyalty and your support. And until next time, we look forward to talking to you again. Hopefully getting into 2022, we can start doing these events in person again. A lot of you know that we typically do a forecast event in January, February, and then we do a halftime report typically in August. So we're hoping to get back to doing that in person, but we'll have to see how things trend. So again, Gene, thank you so much. And to each of you on the webinar today, thank you very, very much. We appreciate it.
Thank you so much.